On May 1st, two senators broke a 9-month deadlock on the most consequential crypto bill in American history. Within 72 hours, Bitcoin tore through $80,000. Circle added $13 billion in market cap in a single session. Athena rallied 40% on the month. Coinbase ticked up 7% in a day. And JPMorgan, the bank that spent a decade calling Bitcoin a fraud and a pet rock, published a research note calling the Clarity Act a positive catalyst and predicting a major crypto rally in the second half of 2026. Here is what nobody is telling you. The same week JPMorgan's research arm was pumping that note to retail investors, JPMorgan's trade association was in Washington lobbying senators to kill the provision that makes crypto yields legal for everyone except banks. In order to really understand what that means, you need to understand Phase 6. Because once you see it, you cannot unsee it. And the Clarity Act is not a crypto victory. It is Phase 6 in real time. JPMorgan is running a dual-track operation on the Clarity Act. Their research arm is bullish for retail. Their lobby is shaping terms for banks. No coordination required. Adam Smith explained this mechanism in 1776, and I documented exactly how it works in my book, The Token Trap. Subscribe now because this channel is the one place connecting these dots in real time. Before we get into the mechanism, a quick map of the terrain, because the Clarity Act is being reported as a binary event, pass or fail, good or bad for crypto, and that framing is wrong. The Digital Asset Market Clarity Act, it passed the House in July of 2025, 294 to 134, with genuine bipartisan support. The Senate Agriculture Committee cleared it in January 2026. It is now sitting on the Senate Banking Chairman Tim Scott's desk, waiting for a markup vote that has to happen before the Memorial Day recess on May 21st. Miss that window, and the midterm calendar swallows it. Galaxy Digital puts the odds of passage in 2026 at roughly 50-50. Polymarket has moved from 46% before the Tillis-Also-Brooks compromise to somewhere between 64 and 70% this week. Here is the question nobody is asking. 50% odds of what exactly? Because the version of this bill that JPMorgan wants to pass is not the same bill the crypto industry has been fighting for. And the version that passes, if it passes, will be shaped almost entirely by who was in the room while retail was watching the price charts. In my book, I document a 6-phase capture pattern that runs through every democratizing technology from the internet to social media to crypto. Phase 6 is regulatory capture. Not opposition to the technology, monetization of it. The infrastructure owners use their scale and resources to shape regulation in ways that enrich their position while appearing to address public concerns. The pattern's genius is that it does not oppose democratization. It monetizes it. The Clarity Act debate right now is Phase 6. Let me show you the 3 tracks running simultaneously. Let's start with JPMorgan because they are the most instructive actor in this entire story. In February 2026, JPMorgan's research team, led by their excellent analyst Nicolas Penny-Gilchoglu, published a note with this line: "We will continue to believe that a potential approval of the market structure legislation, most likely by mid-year, could serve as a positive catalyst for crypto markets into the second half of the year." That note went wide. Retail crypto Twitter went predictably euphoric. JPMorgan says it's bullish. JPMorgan says we're going up. Then in April, JPMorgan published a second report calling the bill close to completion and saying negotiations were nearing a breakthrough. Again, retail picked it up and ran. Now, here is what was happening simultaneously. Jamie Dimon, JPMorgan's CEO, went on CNBC in March and said, quote, "If you are going to be holding balances and paying interest, that's a bank. You should be regulated like a bank. He was talking about stablecoin yield, the provision that determines whether Coinbase can keep the $1.35 billion annual revenue line it earns from USDC rewards. The American Bankers Association, which JPMorgan funds and whose positions track JPMorgan's interest almost exactly, issued a joint statement with 4 other banking trade groups on May 4th, declaring the new compromise language, quote, falls short, and demanding it be tightened up during markup. So, let's be precise about what is happening here. JPMorgan's research arm tells retail investors that passage is bullish and a rally is coming. JPMorgan's CEO and trade association lobby senators to eliminate the yield provision that benefits retail holders of stablecoins. JPMorgan's internal blockchain unit, Connexus, is simultaneously deploying tokenized deposit products on Coinbase's base network and on the private Canton network for institutional settlement. They are building the rails they are lobbying to make illegal for everyone else. Dimon even admitted the strategic pivot explicitly. In his April 2026 annual shareholder letter, he wrote that a whole new set of competitors is emerging based on blockchain, and that JPMorgan needs to roll out its own blockchain technology. This is the same Jamie Dimon who spent a decade calling blockchain a fraud, a pet rock. This is not a conversion. This is a positioning move. He waited until the technology was proven, the infrastructure was built largely by retail-funded crypto projects, and the regulatory environment was about to be locked in by law. Then he declared the debate over and moved to shape the terms of entry. The Coin Bureau, which dropped a very solid video on this today, called JPMorgan's behavior not the behavior of a company that's confident, but the behavior of a company that's scared. I want to offer a different read. JPMorgan is not scared. JPMorgan is executing. There's a difference. Scared companies make defensive moves. JPMorgan is making offensive moves on 2 fronts simultaneously, while a third front, retail sentiment, is being managed by their research notes. That is not panic. That is the same playbook documented in my book across every major technology capture cycle. It maps perfectly onto what I've called Phase 6. Now, Adam Smith wrote about this in 1776. People of the same trade seldom meet together, even for merriment or diversion, but the conversation ends in a conspiracy against the public. We're the public. He was describing 18th century merchants. He could have been describing JPMorgan's Washington operation in 2026. Nobody has to coordinate. They just have the same interest. And when you have enough scale, acting on that interest is indistinguishable from coordination. Now let's talk about Scott Bessent, because his role in this is misread almost universally. Secretary Bessent has been publicly and loudly pro-clarity. He has warned repeatedly that failure to pass the bill will drive crypto capital to Dubai and Singapore. He called passage a spring 2026 target. On the surface, that reads as the Treasury Secretary being a crypto ally. I want to challenge that reading. Bessent's urgency serves a specific function. It creates a deadline that pressures the crypto industry to accept whatever compromise is on the table rather than hold out for better terms. When the Treasury Secretary is publicly warning that the window closes in weeks, the crypto industry's negotiating leverage collapses. You take the deal you can get, or you get nothing until 2030. That is not advocacy. That is deadline pressure applied on behalf of the negotiation dynamic that favors incumbents. Look at what Bessent's urgency does not include. He is not publicly calling out the American Bankers Association lobbying campaign by name. He is not going to the mat for stablecoin yield the way crypto companies are. He is not warning that a weakened bill, one that bans yields for crypto issuers while permitting JPMorgan's tokenized deposit products to earn the same economic return under a different label, is worse than no bill at all. The White House Council of Economic Advisors ran the numbers on the stablecoin yield dispute. Their finding? A complete ban on stablecoin yield would increase aggregate bank lending by $2.1 billion. That is 0.02% of total U.S. loans. The consumer welfare cost of losing competitive returns would be $800 million. In other words, the provision JPMorgan is fighting hardest to kill is worth, to the entire U.S. banking system, less than a single quarter of JPMorgan's earnings. It is not a material financial threat. It is a competitive moat. Eliminate crypto yield and JPMorgan's tokenized deposit products, which can generate yield on the underlying deposits because they are bank held, become the only legal on-ramp with an income component. That is not a level playing field. That is the game. And Bessent's public urgency, by compressing the negotiating timeline, makes it easier to get that outcome written into permanent federal statute before anyone can fully model the implications. I am not saying Bessent and Diamond are coordinating. I am saying they do not need to. They have the same institutional interest in a Clarity Act that locks in regulatory clarity for banks while creating new barriers for non-bank crypto issuers. Adam Smith's insight was that this alignment happens structurally. The book I wrote documents that it happens predictably in every technology sector at every regulatory inflection point. Now, let's look at the actual compromise language that broke the deadlock, because this is where the mechanism becomes concrete. On May 1st, Republican Senator Tom Tillis of North Carolina and Democratic Senator Angela Brooks of Maryland released the Section 404 framework. Here's what it does. Passive yield, the kind that pays you a fixed percentage just for holding a stablecoin idle, is explicitly banned. Staking rewards are permitted. Liquidity provider yield is permitted. Trading rewards are permitted. Cashbacks, loyalty programs, anything tied to what the bill calls bona fide activities gets a green light. On the surface, this looks like a reasonable compromise. The crypto industry is claiming it as a win. Coinbase CEO Brian Armstrong's public response to the language dropping was 3 words: mark it up. Circle's chief strategy officer endorsed it without qualification. Here's what the framing leaves out. Coinbase earns roughly 3.5% of USDC through platform engagement rewards. That income line was approximately $1.35 billion last year, around 20% of Coinbase's net revenue. Under the Section 404 language, that income survives intact because it is tied to platform activity, not idle balances. So Coinbase is fine. Athena, whose entire USDE synthetic dollar generates yield through derivatives funding rates rather than passive deposits, is actually the cleanest beneficiary of the compromise. So Athena is fine. But here's who else is fine, and this is the part the Victory Lap coverage misses entirely. JPMorgan's Connexus tokenized deposit products, they can generate yield on the underlying deposits because those deposits are held inside JPMorgan's banking infrastructure. That yield is not a stablecoin yield. That is a bank deposit yield paid through a tokenized instrument, and it is explicitly permitted because JPMorgan is a bank. The compromise bans the mechanism for non-bank crypto issuers while leaving the economically identical product legal for banks. The regulatory mode is not eliminated by the compromise. It is codified by it. The banking lobby's joint statement on May 4th complained that the language falls short. Read that carefully. They're not saying the compromise hurts them. They're negotiating for tighter language during markup, which would push the yield band further down the stack, restricting more of the activity-based carve-outs that Coinbase and Athena are currently celebrating. If they succeed in markup, the bill that passes will be materially more restrictive than what the crypto industry currently thinks it approved, and it will be signed into permanent federal law. The banking lobby cited $1.3 trillion in potential deposit flight to stablecoins as their justification for fighting the yield language. They contrasted that with the White House CEA finding of $2.1 billion in actual incremental lending impact. That discrepancy is instructive. The $1.3 trillion figure came from research commissioned by the Independent Community Bankers Association, the same trade group that is lobbying against the provision. The White House CEA analysis, which reached a conclusion 600 times smaller, used different methodology and reached different institutional conclusion. I am not going to tell you which number is right. I am going to tell you that when an industry funds research to justify its lobbying position and then uses that research as a basis for its lobbying position, you should weigh it accordingly. There is a third piece in the Clarity Act that has gotten almost no coverage, and it is arguably more consequential than the stablecoin yield fight. Section 604 is a single paragraph drawn from the Blockchain Regulatory Certainty Act, folded into the Clarity Act. It explicitly states that non-custodial developers, the people who write open source smart contract code without ever touching user funds, cannot be classified as money launderers, brokers, or financial intermediaries. For years, US-based DeFi builders have operated under the threat that publishing code alone could result in criminal money transmission charges. The White House Digital Assets Advisor Patrick Witt confirmed that only 19% of crypto developers are currently US-based. I'm one of them. The other 81% have already moved to Dubai, Singapore, or MiCA-regulated Europe. Section 604 is designed to reverse that. Senator Cynthia Lummis has called this the strongest protection for DeFi developers ever enacted. Now, here is why Section 604 matters to the capture thesis and why it is not getting enough attention. If Section 604 survives markup and becomes law, open source crypto development in the US gets legal cover. That is genuinely good for decentralization, for retail builders, and for the crypto ecosystem that actually competes with JPMorgan's infrastructure. And Section 604 matters for something beyond legal protection. It makes a different funding model possible. The traditional token project works like this. Issue tokens, sell to retail at launch, founders and VCs exit into that retail demand. Retail becomes the exit liquidity. That's the model my book documents across hundreds of projects. The yield-funded alternative looks completely different. A protocol issues a stablecoin, earns yield on its reserves as the network grows, and uses that yield to fund development continuously, without a token dump, without a retail exit event. It is a cleaner model. It aligns incentives differently. It does not require a crowd of buyers at the moment of launch to make the economics work. Section 404's yield band, if tightened in markup, kills that model for any non-bank entity in the US before it can be tested at scale. That is not a theoretical loss. That is a specific alternative to the extraction playbook being removed from the table by the same institutions that benefit from the extraction playbook remaining the only option. The implication in most coverage and in an earlier version of my thinking on this is that developers fleeing to Dubai, Singapore, or MiCA-regulated Europe escape the yield restriction, that those offshore jurisdictions are where you can build the economic engine the US is blocking. That is wrong, and it matters. MiCA, the EU's comprehensive crypto framework, bans yield-bearing stablecoins categorically. Article 22 of MiCA explicitly prohibits issuers from granting interest or any other benefit related to the length of time a holder holds their tokens. The design intent is explicit in the legislative record: prevent stablecoins from competing with bank deposits. European policymakers used almost identical language to the American Bankers Association. Different continent, same conclusion, same beneficiary. Singapore's MAS framework prohibits stablecoin issuers from engaging in lending, staking, or any activity where interest is paid to customers. Dubai's VARA requires licensing for yield products at scale, and the Central Bank of the UAE restricts payment token issuance to bank equivalent institutions. VARA is much more accessible than a US bank charter, and that matters for builders. But the yield restriction follows you there, too, at scale. The Oxford Faculty of Law published an analysis of this convergence in March. Their finding? The US and EU appear aligned on the stablecoin yield question rather than divergent. The escape hatch is not open. So, when Secretary Bessent warns that failure pushes the industry to Dubai and Singapore, he's describing a migration where developers can code more freely, but the economic model that makes decentralized stable asset issuance viable runs into the same banking protection logic in every major jurisdiction it might run to. Section 604 gives U.S. developers legal cover to stay and build. What it cannot fix is that the global regulatory consensus on stablecoin yield was shaped by the same institutional interest in every room, in Brussels, in Singapore, in Abu Dhabi, and now in Washington. Adam Smith was writing about 18th century English merchants. He was also, it turns out, writing about the BIS working groups and central bank consultations of 2023, 24, 25, and now 2026. People of the same trade across borders reaching the same conclusion about who should be permitted to pay yield on digital money. Nobody coordinated. They just have the same interest. Section 604 is a real win. It keeps people like me building in the US instead of leaving. But the yield-funded development model, the alternative to the extraction playbook, faces the same wall globally. And the bill that locks the yield restriction into American federal statute, whatever version passes in the next 14 days, is the American chapter of a global architecture being written permanently into law. So, where does this leave us in the next 14 days? The signals to watch are specific. Chairman Tim Scott needs to formally calendar a markup date in the week of May 11th. That is the primary bullish catalyst. Senator John Kennedy of Louisiana is the notable Republican holdout, and his frustration is reportedly tied to unrelated housing legislation he's using as leverage, not principled opposition to the bill. If Kennedy publicly endorses or steps aside, the markup happens. If the American Bankers Association escalates to direct senator by senator floor lobbying, that is your signal that they think a compromise language is more favorable to crypto than they want, and they're going to try to tighten it up in markup. Watch for that escalation. Polymarket sits between 64 and 70% for passage as of this week, up from 46% before the May 1st compromise. Galaxy Digital's Alex Thorne puts real odds closer to 50-50, citing the 60-vote Senate floor threshold and the sheer number of unresolved procedural steps that have to happen in sequence before August. Both numbers are probably right depending on which question you're asking. 64 to 70% that something called the Clarity Act passes, 50-50 that the version passing is the one the crypto industry is currently celebrating. Maybe a little less. The version that matters for retail participants in this ecosystem is not whether the bill passes. It is what Section 404 looks like after markup. If the activity-based yield carve-outs survive intact, the crypto industry gets a workable framework and the open ecosystem has some room to compete. If the banking lobby succeeds in tightening the language during markup, the bill that passes locks into a two-tier system. One where banks can issue yield-bearing tokenized instruments and non-bank issuers cannot. That version is worse than no bill because it is permanent. The May 21st Memorial Day deadline is real. Miss the markup and the midterm calendar closes the window. Miss 2026, and this goes to 2020-30 at the earliest, by which point JPMorgan's Connexus framework has 5 more years of runway to establish market position before a regulatory framework arrives. Secretary Bessent is right that delay hurts the crypto ecosystem. He's just not specific about who delay hurts more. Here is where I will leave you. My book, The Token Trap, documents a 6-phase capture pattern that has run through every major democratizing technology in the last 30 years. Phase 6 is always regulatory capture. Not opposition, Monetization. The infrastructure owners do not fight the technology. They wait until it is proven, then they shape the law that governs it. The Clarity Act debate is textbook Phase 6. JPMorgan's research arm pumps retail optimism. JPMorgan's CEO lobbies to shape the stablecoin yield terms. JPMorgan's internal blockchain unit builds the infrastructure that benefits from the terms they're lobbying for. Nobody coordinates. They just have the same interest. And if Section 404 survives markup with the activity carve-outs intact, the crypto industry gets a real win. If the banking lobby tightens in the language in the next 14 days, retail just did the political work of passing a bill that cements banking's advantage in the tokenized economy. You were never the investor. You were their exit liquidity. Subscribe now. Watch the May 11th week for the markup calendar. I'll be back the moment it moves. The Token Trap is available now on Amazon. Link in the description. If anything in this video connected, the book is where the full architecture lives. I'm Dana Love. I'll see you in the next one.